Last week marked the 10th anniversary of the collapse of Lehman Brothers and the start of the Great Recession. And some experts say that another financial crisis is inevitable. So perhaps it is time to review the opinions of two of history's greatest investors, Jack Bogle and Warren Buffett. So let's take a look. Jack Bogle graduated from Princeton with his senior thesis titled The Economic Role of the Investment Company. Bogle went on to found the Vanguard Group Mutual Fund Company in 1976. He debuted the Vanguard 500. He was the pioneer of index investing as a low-cost, high-return option for the everyday investor. And some quotes attributed to Jack Bogle include, "It's 100% economics in the stock market and 0% emotions." Also, "Time is your friend. Impulse is your enemy." He also said that if you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks. And lastly, he said, when reward is at its pinnacle, risk is near at hand. And in a recent interview with CNBC, Bogle said there are always blind spots, or, as he had said, the fog of the stock market. Nobody really knows what's going on. And thanks to the 2008 crisis, he stated that there are risks that we know, but there are risks that we don't know even exists. And that's the problem. Every crisis is different. Every bear market is different. While there are lots of signs of exposure in the market, Bogle said that's not stopping him from investing. "Nothing right now would cause me to get out of a long-term investment program, and certainly nothing would stop me from continuing to put away $100, $200, or $500 every month in my 401k or my IRA. And that's because buying and holding for the long term tends to be an effective investment strategy, no matter the economic climate." And Bogle said, "If you hold the stock market, you will grow with America." And then there's Warren Buffett. In the fall of 2008, global markets were failing. Lehman Brothers, an investment bank with $600 billion in assets, filed for bankruptcy protection on September 15th. 2 weeks later, the U.S. stock market lost $1.2 trillion in value as the Dow dropped 778 points, or nearly 7%. "You just felt like the world was unraveling," a senior equity trader named Ryan Larson told the New York Times that day. "People started to sell, and they sold hard. It didn't matter what you had, you sold." But there was one big investor who had a different outlook. Berkshire Hathaway's CEO, Warren Buffett. In fact, Buffett was buying. "I've been buying American stocks," Buffett wrote in an opinion piece for the New York Times. Buffett understood the severity of the crisis. He told CNBC that year it was like an economic Pearl Harbor. So why was Buffett buying stocks that were rapidly falling in price when everyone else was raising cash? A simple rule dictated his buying. Be fearful when others are greedy, and be greedy when others are fearful. In his view, the long-term value of innovative American business would continue to grow despite the short-term pain of the crisis. Buffett warned against investing in highly leveraged entities or businesses in weak competitive positions, but urged readers to see that the downturn provided an opportunity to buy strong companies at low prices. In short, bad news is an investor's best friend, he said. It lets you buy a slice of America's future at marked down prices. Buffett explained in an op-ed fears regarding the long-term prosperity of the nation's many sound companies makes no sense. These businesses will indeed suffer earnings hiccups as they always have, but most major companies will be setting new profit records 5, 10, and 20 years from now. Buffett's strategy wasn't perfect. He admits his timing was a bit off in his October call to buy, whereas markets continued to plunge into 2009. It was the right thing on a long-term basis, Buffett told CNBC, but it was way off about 4 or 5 months at least. People start being interested in something because it's going up, not because they understand it or anything else. Buffett said the guy next door, who they know is dumber than they are, is getting rich, and they aren't. But instead of acting on emotional instincts, Buffett's advice is to follow that simple rule. Though markets are generally rational, they occasionally do crazy things, Buffett said. Seizing the opportunities then offered does not require great intelligence, a degree in economics, or familiarity with Wall Street jargon such as alpha and beta. Buffett stated, what investors need instead is an ability to both disregard mob fears or enthusiasm and to focus on a few simple fundamentals. A willingness to look unimaginative for a sustained period, or even to look foolish. And boy, do I know what it means to look foolish. So for today, that's ChewDog Charts. Thank you.